Most retirees hit age 70 and a half thinking they finally understand the tax rules. They've done their research, they've talked to their accountant, maybe they've even watched a few videos on retirement planning. But here's what nobody tells you. The IRS has a set of rules that quietly kick in right around that age, and most people don't find out about them until they've already made a costly mistake. We're talking about rules that can cost you thousands of dollars, rules that can trigger penalties you didn't even know existed, and honestly, rules that, if you use them the right way, can actually save you a significant amount of money. Today on James Retires, we're going to walk through 7 of those rules, one by one, in plain English, so you can stop guessing and start making smarter decisions with your retirement money. Before we go any further, if you're new here, welcome. James Retires is all about helping everyday Americans navigate the financial side of retirement without the confusing jargon and without the fear-mongering. Hit that subscribe button right now and tap the bell so you don't miss our weekly videos, because every week we cover something that could genuinely change how much money you keep in retirement. And if this video helps you today, hit the like button. It takes 2 seconds, and it helps more people find this content. Okay, let's get into it. The first rule is one that catches people completely off guard, and it has to do with required minimum distributions, or RMDs as they're commonly known. Most people have heard of RMDs. They know that at some point the IRS forces you to start pulling money out of your traditional IRA or 401k. What most people don't know is exactly how the penalty works if they miss one. For years, the penalty for missing an RMD was 50% of the amount you were supposed to take out. That is not a typo, 50%. Miss a $10,000 RMD and owe the IRS $5,000 just in penalties. But here's what changed. Thanks to the Secure 2.0 Act, that penalty dropped significantly. It's now 25%, and it can drop all the way down to 10% if you correct the mistake in a timely window. This is a huge deal, but many retirees still think the old 50% rule applies, and they panic unnecessarily. Or worse, they don't know the new rules and miss the correction window entirely. Know where you stand, because this one rule alone can mean the difference between a manageable situation and a financial gut punch. The second rule involves something called the still working exception, and it's one of the most misunderstood benefits in the entire tax code for older workers. Here's the thing. If you're still working past age 73 and you have a 401k with your current employer, you may not be required to take RMDs from that specific account while you're still employed. Let me say that again clearly because it matters. If you're still on the payroll, still contributing, still actively employed, the IRS may let you leave that money alone and let it keep growing without forcing distributions. But, and this is a critical but, this exception only applies to your current employer's plan. If you have an old 401k sitting around from a job you left 10 years ago, that old account is absolutely subject to RMD rules. And your traditional IRA, that doesn't qualify for this exception either. A lot of people hear the general rule and assume it covers everything. It doesn't. You have to know exactly which accounts are eligible, or you could accidentally skip an RMD you're actually required to take. Rule number 3 is about qualified charitable distributions, and honestly, this one is a gift that millions of retirees are leaving on the table. Once you hit age 70 and a half, not 73, not 72, once you're 70 and a half, you become eligible to transfer money directly from your IRA to a qualifying charity. This is called a QCD, a qualified charitable distribution. And here's why it's so powerful. The money goes directly to the charity and it counts toward your RMD, but it never shows up as income on your tax return. That's the magic. If you are planning to donate to your church, your local food bank, your favorite cause anyway, and you're pulling that money from your IRA in the normal way first, you're paying income tax on it before it gets to the charity. A QCD bypasses that completely. The limit right now is over $100,000 per year per person, and for married couples, that doubles. This single strategy can reduce your taxable income, keep you in a lower tax bracket, reduce the portion of your Social Security that gets taxed, and potentially help you avoid Medicare premium surcharges. It is one of the most powerful tools available to retirees over 70 and a half, and the vast majority of people have never even heard of it. Number 4 is about the one rollover per year rule, and this is where people get into real trouble. You may know that you can roll money from one IRA to another. What you may not know is that the IRS has a very strict limit. You can only do one IRA to IRA rollover in any 12-month period, not per calendar year, per 12 months. If you do 2 rollovers in that window, the second one gets treated as a taxable distribution. You owe income tax on the entire amount. And if you're under 59 and a half, you also owe a 10% early withdrawal penalty on top of that. Retirees sometimes think they can shuffle money around between accounts freely, moving things around for convenience or chasing slightly better interest rates. But that second rollover can trigger a tax bill that completely wipes out any benefit you were hoping to gain. Now, there is a workaround. Direct trustee-to-trustee transfers, where the money moves directly between financial institutions and never touches your hands, do not count toward this limit. But if you take a check and deposit it yourself, that's a rollover, and the clock is running. Rule 5 is one that surprises even financially savvy retirees, and it has to do with how your IRA contributions interact with your RMDs. Here's a question. Once you start taking RMDs, can you still contribute to a traditional IRA? The answer used to be no. Before the Secure Act changed things, once you hit age 70 and a half, you could no longer put money into a traditional IRA. That rule is gone now. As long as you have earned income, wages, self-employment income, something you actively worked for, you can contribute to a traditional IRA at any age. But here's the twist. Just because you can contribute doesn't mean you should. If you're taking RMDs at the same time as making contributions, you may be creating a cycle that doesn't actually reduce your taxes the way you think it does. And Roth IRA contributions are treated differently. There are no age limits and no RMD requirements during your lifetime on a Roth. Understanding the interaction between these accounts after age 70 is genuinely complex, and getting it wrong can cost you. Rule 6 goes back to RMDs, but from a different angle. Specifically, how the IRS calculates how much you actually owe. The amount of your RMD isn't random. It's based on your account balance at the end of the previous year, divided by a life expectancy factor from IRS tables. The IRS updated those tables a few years back to reflect the fact that Americans are living longer, which actually reduced RMD amounts slightly for most people. But here's what a lot of retirees don't realize. If your spouse is your sole beneficiary and they are more than 10 years younger than you get to use a completely different, more favorable table called the Joint Life and Last Survivor table. This table gives you a longer life expectancy factor, which means a smaller required distribution each year, which means less taxable income. If you're in this situation and your financial institution or your accountant has been using the wrong table, you could have been taking out and paying taxes on more money than you were actually required to. That's not a small difference over time. Go back and check which table is being used for your calculations. And Rule 7, the one that probably has the most real-world impact on your day-to-day retirement expenses, involves how your RMDs can trigger something called IRMA, which stands for Income-Related Monthly Adjustment Amount. Most people know that Medicare isn't free. You pay premiums. What they don't know is that if your income goes above a certain threshold, the government charges you significantly more for Medicare Part B and Part D. And here's the brutal part. They look at your income from 2 years ago to make this determination. So a large RMD you took this year could bump up your Medicare premiums 2 years from now. A lot of retirees get blindsided by this. They take a big distribution, maybe to remodel the kitchen or help a child with a down payment, and 2 years later, their Medicare costs jump hundreds of dollars per month, and they have no idea why. This is why proactive planning, spreading out distributions, doing Roth conversions in lower income years before RMDs kick in, is so critical. Once the income is on the books, there's very little you can do to undo the Medicare premium impact. Here's the bottom line. The IRS rules after age 70 and a half are not designed to be simple or intuitive. They layer on top of each other in ways that punish the uninformed and reward those who take the time to understand them. Whether it's the new RMD penalty rules, the still working exception, the power of qualified charitable distributions, the one rollover per year trap, contribution rules, a life expectancy table selection, or the Medicare premium time bomb. Each of these rules is something every retiree or near retiree should know, and knowing them isn't enough. You have to apply them to your specific situation. Talk to a qualified tax professional or fee-only financial advisor who specializes in retirement income. Don't assume what worked for your neighbor's situation will work for yours. If this video helped you understand even one thing you didn't know before, please leave a comment below and tell us which rule surprised you the most. Was it the QCD strategy, the Medicare connection, the life expectancy table issue? We read every single comment on James Retires, and your input helps us decide what to cover next. And if you have a friend or family member who's approaching retirement or is already past 70, do them a favor and share this video with them. One of these rules could save them thousands of dollars, and that's not an exaggeration. We'll see you in the next one.